just to keep on top of this, let's go ahead and take a look at that same example, example 3.4, but now let's go ahead and do this using the cost method, and we'll dispense with the worksheets for the moment and just focus on the elimination entries. So again, in example 3.4, we had on January 1st, 2018, Big purchased 60% of the voting stock of Little for $180,000. On that date, the fair value of the non-controlling interest was $120,000. Little's book value was $300,000, and all of their assets and liabilities had fair values equal to book value, and we had information on income and dividends for 2 years. So first, let's go ahead and account for our investment in 2018. We purchased our investment for $180,000, same as before. And then when we receive our dividend check, 60% of $50,000, that dividend check is recorded as investment income under the cost method. Again, under the equity method entry, we would be debiting the investment in Little account. We go to our elimination entries, and in the first year of ownership, there's no difference as far as this initial elimination entry is concerned. We eliminate Little's beginning of year owner's equity accounts. That total of $300,000 is split 60-40 between the investment in Little and the non-controlling interest. One place where there is a change is that now we're going to combine the I for income and D for dividends entry. Little declared dividends of $50,000. The parent's share, as shown in the entries up above, was recorded as investment income. That's what we have to eliminate here. The non-controlling interests portion is handled in the usual fashion. And then we do the income to the non-controlling shareholders in the usual fashion as well. So again, as far as our elimination entries in the year of acquisition are concerned, the only change is that we're combining the I for investment income and D for dividends entry because the dividends received by the parent are in fact their investment income. Moving on to 2019, we go through the same process. We receive our $18,000 in dividends, 60% of the $30,000 paid by Little. And now we go to our elimination entries. As before, we eliminate the subsidiaries' beginning of year owner's equity accounts. Those total up to $290,000. The non-controlling interest gets 40% of that, or $116,000. The parent's share of that $290,000 is 60%, or $174,000. Now, if we'd been using the equity method, at this point we would dutifully credit the investment in Little for $174,000. Instead, however, because Big is using the cost method, their investment in Little account is stuck at $180,000. So we're going to go ahead and credit the investment in Little for $180,000. The $6,000 difference is going to be an adjustment to Big's beginning retained earnings. And again, there are a couple ways we could do this. One, we could just sort of, cast our lot with fate and say, well, gee, this doesn't balance. The plug figure must be a debit or credit as appropriate to retained earnings. If you wanted to be a little more systematic about it, you'd say, look, in 2018, under the cost method, we Big reported an investment income of $30,000. If we had been using the equity method, we would have recorded investment income of $24,000. So because we were using the cost method, we reported an extra $6,000 in income, which means we now have an extra $6,000 in retained earnings. To correct this, we need to reduce our retained earnings by $6,000. We go to our combined I and D entries again, and again we eliminate the subsidiaries' dividends declared, and that gets allocated between the parent's investment income and the non-controlling interest, and then the income to the non-controlling interest in the usual fashion. Now, it wasn't requested in the way the problem was initially written, but let's go ahead and go on to 2020 and just look at that first elimination entry. Again, we would eliminate the subsidiaries' beginning of 2020 owner's equity accounts. Common stock and paid-in capital in excess of par are still at their original values. Retained earnings is now up to $60,000. Again, last year it was $40,000. Little earned $50,000, paid out $30,000 in dividends, so their retained earnings is now up to $60,000. That all totals up to $310,000. and we will dutifully allocate 40% of that, or $124,000, to the non-controlling interest. Now the parent's share of that $310,000 is $186,000. However, their investment in Little is fixed at $180,000. So again, we've got this $6,000 discrepancy, and it's just a coincidence that there was a $6,000 discrepancy in 2019 also, just a coincidence of the way the numbers played out. So to make this thing balance, we need another $6,000 credit, and again, that's going to be an adjustment to retained earnings. That's the difference between what the parents' retained earnings would have been had they used the equity method and what it was given that they used the cost method. If they had been using the equity method all along, their retained earnings would have been $6,000 higher. So we're going to go ahead and adjust the retained earnings to the correct level. And finally, as I've stated over and over before, and will state over and over again in the future, whenever we do an adjustment to retained earnings in our elimination entries, that's always an adjustment to our beginning retained earnings. We adjust beginning retained earnings in the consolidation worksheet and let that changed amount flow through to our ending retained earnings.